Hi, a very good afternoon to all attendees, and thank you for joining our webinar on the topic of understanding the elements of badges of trade. My name is Brandon, and I'm an associate with the Tax, SST, and Customs team of RDS. And together with me today will be Sophia from RDS. And maybe Sophia, you could briefly introduce yourself.
Okay. Hi guys, thank you for joining our webinar this afternoon. My name is Sophia. I'm an associate with RDS under the tax team along with Brandon as well. I major in petroleum income tax, transfer pricing, as well as income tax matters.
Right. So our today's topic will be on badges of trade, and the main distinction between capital or revenue income will be discussed between Sophia and I, and to understand what type of income falls under revenue and hence subject to income tax under the Income Tax Act. So today we will also don't forget to sign up for our next webinar on protection of house buyers by our associates Lisa and Rachel, and the link will be in the chat box. It will appear in the chat box in a short while. Yes, don't forget to sign up for that. Okay, so the itinerary for today's webinar will be derivation of income under the Income Tax Act and how income will be subjected to tax. Secondly, it will be badges of trade and recent case laws on the badges of trade, whether an income falls within capital nature or revenue, and lastly, Q&A. Okay, to start off, we'll talk about what is a taxable receipt. So basically, a taxable receipt is income deriving from some sort of trade. So an example given is if A purchases a house to use as a family home and sell the house some years later at a profit, whereas that there is an addition to his wealth, and this will result in increase of market value of the house. And hence, the house as an investment will not be a stock in trade. However, if A is actively involved in the buying and selling of real properties, real estate, and therefore the gains will then be subjected to income tax. Moving on, Section 3 provides for the charging section of income, where it says that income tax shall be charged for each year of assessment upon the income of any person accruing in or derived from Malaysia or received in Malaysia from outside Malaysia. So there are two circumstances where an income will be subject to income tax in Malaysia. Firstly, the income must be accrued or derived in Malaysia. Okay, so let's say if I'm currently running a business in Malaysia and I have derived income from, let's say, a chicken rice store, then of course the income will be derived in Malaysia. And secondly, the income must be received in Malaysia and not from outside of Malaysia, because foreign source income are actually now exempt from income tax, which we will be discussing a bit further later. So these are the types of income which are taxable in Malaysia. So a few examples of taxable income will be trading receipt, salary, receipts received in ordinary course of business, illegal income, of course, that will be questionable, payments for services rendered, and also disposal of trading stocks. Non-taxable income will be capital receipts, saving of an expenditure, gambling gains. For example, we have derived earnings from the casino, or even buying numbers, 4D numbers. Those are not taxable. Disposal of capital assets such as shares, gifts, capital, and also ang pao. And tax income which are exempted from income tax are basically foreign source income, honorarium, dividend, and those incomes specifically exempted under Section 1273A of the Income Tax Act. So in essence, we don't have a capital tax regime in Malaysia. However, gains arising from the disposal of real properties is subjected to tax, whereby it is capital gain under the real property gains tax, or alternatively, where the capital receipt is treated as a revenue receipt under the Income Tax Act. And the fine line in distinguishing this, we will be discussing it further under the elements of the badges of trade. So these are the rates of the real property gains tax which are chargeable in Malaysia. So it will depend on the number of years the property is held by an individual or companies. And the rate differs as the time goes on. Okay, moving on, Section 4 provides for the classes of income whereby taxes are chargeable. In brief, they are laid down in subsections A to F of Section 4 of the Income Tax Act, which provides for business income, gains from employment, dividends, interest, discounts, rents, royalties or premiums, pensions, annuities, or other periodical payments, or any other gains or profits not falling under any of the heads between A subsection A to E. Okay, starting off with section A, 4A, which are gains of profits from a business. This is, I believe, quite straightforward, whereby this income is derived from the carrying out of a profession, vocation, and trade, or any other manufacture, adventure, or concern in the nature of trade. However, this excludes employment income. And a key point to identify whether a business exists will be there must be some repetition or frequency of transactions, as held in the Singapore case of DEF. We will discuss more about this case further in the headings of the badges of trade. Trade, on the other hand, refers to activities of commercial nature, whereby the most common will be buying and selling goods. And of course, Section 4B provides for gains or profits from an employment. Therefore, any employment income will be subject to income tax. Let's say I am currently employed by RDS, and therefore the gains from my current employment will therefore be subjected to income tax. Moving on, dividends, interest, discounts. Rent is also subjected to income tax, whereby we let out our properties if we have immovable or movable property. The rent derived from the letting out of such properties will be subjected to income tax. Premiums as well, whereby it is a once and for all payment, usually involved in a lease arrangement between parties. And Section 4F. Section 4F basically provides a very wide scope to cover any other gains which does not fall under the headings of subsection 4A to 4E. And in order for an income to fall under subsection 4F, they must not fall under any other head of charge first. And generally, this will include casual profits or income. For example, commissions derived from the sale of houses or cars, as an example, whereby we are not actively in the trade of such, or maybe also occasional appearances, TV appearances. So, for example, if Sophia were to be invited to the Ellen show one day and she is given a token for appearing, then therefore such gain will also be will fall under Section 4F of the Income Tax Act. Okay, moving on. Therefore, how do we establish the existence of a trade? So the key principle as established by our courts is the notion of badges of trade. And in doing so, we have to give regard to the surrounding circumstances of a certain transaction, as held in the local case of NYF Realty, whereby the court has laid down basically 7 badges of trade, which are profit-seeking motive, subject matter of the transaction, frequency of transactions, period of ownership, circumstances leading to the transaction, modification to property, and trading interest and knowledge in the same or similar field. We will go into detail into each of the headings of these badges of trade. Okay, just a bit of context on what are badges of trade. The distinction between whether a gain arising from the disposal of a particular transaction is capital or revenue is actually big, and that is why we need to identify the existence of such badges of trade to actually guide us into identifying whether a particular transaction is in the nature of trade. So basically, the first and very obvious factor for us to consider is there a profit-seeking motive. Therefore, firstly, it is pertinent for one to consider the underlying purpose in acquiring the property, and the focal point of inquiry is the dominant purpose for which the particular property was originally acquired. Therefore, for example, if a person has the sole intention of acquiring a property solely for investment purposes and not to trade in properties, then of course we have to take into account such considerations whereby there is no profit-seeking motive. However, if a person has intentionally acquired a piece of land for the sole reason of developing and subsequently selling the land at a significant higher price, then of course we could then establish that there is an intention to trade. So the 2 main cases on profit-seeking motive, which are instructive, is NYF Realty and also Lower Perak Cooperative Housing. Okay, starting off with the case of Rutledge against Commissioner. In this case, a UK citizen went to Germany and purchased 1 million unit of toilet rolls. He then came back to the UK and sold the toilet rolls in a single transaction for a significant gain. Subsequently, the revenue has come and taxed the taxpayer on income tax. However, the taxpayer contended and said that it is capital in nature because it is the transaction happened in a single single transaction, and therefore it should be capital in nature. However, the court had held that a single transaction is taxable as a revenue receipt if it is in the nature of trade. A bit of context: there is no reasonable person that will purchase 1 million units of toilet rolls for their personal use. Therefore, the taxpayer's basis does not hold water that it is capital in nature. Okay. And therefore, the court has established there is indeed an intention for the taxpayer to resell those toilet rolls at a profit at a later time. Moving on to in the case of Lower Perak Cooperative Housing. In this case, the taxpayer purchased a piece of land. The land was later subdivided with the sole intention to build houses and to sell those houses to its members. Bearing in mind that the taxpayer is a housing society, it then entered into agreements with developers to develop the land. The developer bought a portion of subdivided land and subsequently agreed to sell some of it to the taxpayers' members at the same price. However, due to unforeseen circumstances whereby the demand was poor, the taxpayer This led to the taxpayer to sell the remainder of the lots to the developer. In this case, the issue is whether the sale of the lots by the taxpayer to the developer was taxable under the Income Tax Act. Of course, the taxpayer takes the position that the sale of the land was a capital gain and therefore not subjected to income tax. However, in delivering its judgment, the Supreme Court had held that the subdivision was done in furtherance of the cooperative society's aim of pooling its financial resources of all its members, and with the aim to purchase a plot of land with a view to satisfy the domestic need of each of the livelihood, basically, of the members, of having a roof over its head. And this will therefore will not signify a batch of trade. And in this case, there is also the element of compulsion, whereby the transaction was actually carried out under the taxpayer actually entered into this transaction under external pressure, and therefore such element of compulsion vitiates any intention on the taxpayer to conduct the trade. Moving on to subject matter of the transaction, my colleague Sophia will take over from here onwards. Thank you.
Thank you, Brandon. Okay, so one of the next badges of trade is the subject matter of transaction. So for example, if you buy a house, most likely it will be like, for example, for investment purposes, as well as personal pleasure items such as jewelry, paintings, fine bone china, which is, I Googled, is like fine pottery and all those kind of things. Most likely is that you purchase all these kind of items, not with the intention to trade, but the intention is like, for example, for personal pleasure as or for the purposes of investment. Brandon. Okay, so for example, in the case of hypergrowth, this was one of the case where it was the case involved the selling of shares. In this case, the company was owned by a taxpayer whose occupation is to work as a veterinarian. The company acquired shares, invested, wholesale, resell, and reinvested the shares. And then for one particular company, the company bought the shares, and then due to the poor market conditions, the company actually sold the shares suddenly. And then after that, the company actually made a profit on the sale of the shares. And then the Inland Revenue Board actually wanted to tax the sale of the shares as revenue receipts. However, the taxpayer's contention was that the purchase of these shares was not with the intention to buy and sell immediately. The intention was that they wanted to hold it as a long-term investment. And then but the taxpayer, they were forced to sell the shares because of the deteriorating market condition. And then so the taxpayer appealed to the Special Commissioners of Income Tax, which is the tribunal which taxpayers will appeal to in the event that they are not happy with the decision of the Inland Revenue Board. So the SCIT actually found in favor of the taxpayer, and then the Inland Revenue Board actually appealed to the High Court. The High Court held that the taxpayer was at all times an investment company, and they did not have the means, knowledge, or expertise to be able to be traded in shares. Therefore, the court took the incident of the selling shares as an isolated act, and therefore it was not taxable as a revenue receipt. Moving on, so in contrast, UN Finance Berhad was also similarly a case about the taxpayer buying and selling shares. This case actually went up all the way to the federal court, which is the highest court of the country. So in this case, the taxpayer actually, according to the Articles of Association, they actually had the power. They actually had the power to acquire movable and immovable properties by way of investment. One of the investment that the company undertook was to purchase and sell shares and the taxpayer actually made considerable profit from the purchase and sale of the shares. So the Inland Revenue Board similarly wanted to tax this sale of shares, profit made on the sale of shares as a revenue receipt. So the decision of the federal court was that the taxpayers were carrying on the business of trading shares, different to hypergrowth, whereas in hypergrowth, the taxpayer, the court actually found that they wanted to help the shares for investment purposes. The court in this instance actually found that the company was engaging in trading of shares because one of the object of the company was to trade in shares. Therefore, different from hypergrowth, in this case, the court actually held that the profit made from the sale of shares were taxable under the Income Tax Act and as revenue receipts. Okay, moving on. So the third badge of trade would be circumstances responsible for the transaction. So for example, sometimes you may purchase a property or purchase an asset with a view that you wanted to keep it for a very long term. But however, circumstances are such that you suddenly have to, like, for example, you need the money, urgently right now, or poor market conditions, etc. These are factors which may constitute eliminating the badges of trade. So one of the hallmark cases is the case of Metacorp development. So in this case, the taxpayer actually is a property developer and they held 2 parcels of land in Malacca. And then these lands were subsequently compulsorily acquired by the state government of Malacca. And instead of subjecting the land to income tax, the taxpayer actually subjected them to RPGT instead. And then, of course, the Inland Revenue Board, they contended that the sale of these lands were actually revenue receipts. But however, the decision was that because the land was compulsory acquired, it vitiated the intention to trade, and therefore the compensation received by the taxpayer was not taxable. Okay. Another factor that the court may take into consideration is the frequency of transaction. So for example, if I were to actually only sell in one shot rather than like in the course of a very short period of time, I have 10 transactions, it is more likely than not that the court will take the situation where if you have a very short time, a large number of transactions, and that it is most likely that the taxpayer is engaged in the trade. Whereas if you were to engage in only one transaction in over a long period of time, chances are is that this is actually not in a cost of trade, but a capital receipt. So, so the court has adopted a holistic approach where if you want to determine whether or not it is in the nature of trade, the frequency of it has to be considered. Okay, yeah, next. Okay, so but then again, the period of ownership is not actually determinative of whether a taxpayer's intention to trade. For example, in the case of DEF and Controller of Income Tax, which is a Singapore case, the taxpayer actually only held the land for 3 weeks. But however, the court held in favor of the taxpayer in finding that the sale of the land was actually a capital receipt. Similarly, in the case of BI Co. Sdn Bhd, the length of ownership was about 6 years, and therefore the court found that it was also a capital receipt. Similarly, in PR Sdn Bhd as well. So, whether you held the land for like 3 weeks, a year, or 6 years, it is very important that you keep proper documentation as to the intention of acquisition, so that, for example, in the case of 3 weeks, the court might take a different approach in finding that you actually acquired the asset with the intention to have a quick turnaround to make a profit, and therefore is trade in nature. Okay, moving on. Another important badges of trade, it would be a modification to property. Now, modification, it can come in many forms, but like, for example, it is anything that you do to the asset in order to increase the market value of the asset to make it more saleable and therefore to make a profit. For example, in the case of Brandon, next slide. For example, in the case of a Cape Brandy syndicate, what happened was that this was actually a wine syndicate who they joined with another syndicate and they purchased a large amount of brandy from South Africa. Now, what happened is that they actually mixed the brandy with French brandy and then repackaged it and resold. So the question was whether, so they tried to make modifications to the existing brandy to make it more saleable. However, the taxpayer argued that this transaction was capital in nature, as the appellants, they were never. Yeah, okay, next. Okay, so the court actually held that the sale of the brandy, they were actually taxable under the Income Tax Act because of the efforts that was being put into making the brandy more saleable. Okay. Another case was the case of Commissioners and Inland Revenue, Livingston others. This is also another English case. In this case, there was actually 3 taxpayers who never engaged in buying and selling of cargo vessels. On this one occasion, they decided to buy a cargo vessel and converted it into a steam drifter and sell it. So what happened was that they spent a lot of money to repair the cargo vessel, to make it because it was quite in a bad condition when they purchased it. And when they sold it, they actually made a huge amount of profit. The taxpayers actually argued that these were a capital receipt because they have never been engaged in the buying and selling of steam drifters. However, in this case, the court actually also held that the taxpayers, they were engaged in trade, as they were said, as seen in the quotation, and it says that the profit made by the venture arose not from mere appreciation of the capital value, but from the expenditure of the subject purchase of money laid out for it for the purposes of making it a more marketable at a profit. So if you actually purchase an asset and then you actually spend a lot of efforts to be able to repair it, improve it, make it to be able to make a profit out of it, it is most likely to be engaged in the nature of trade. Okay, so a Malaysian case would be in the case of Gra Sdn Berhad and KPHDN. This was the taxpayer is an investment holding company where it held 2 parcels of land, and then the taxpayer actually sold the land 6 years later. In this case, the court actually took cognizance that the taxpayer didn't do anything on the land. From the time that they purchased it until it was sold, the taxpayer did not do any alteration or improvement to the land. And so they found in favor of the taxpayer in finding that the sale of the land was a capital receipt and taxable under the Real Property Gains Tax Act instead of the Income Tax Act. Okay, so another one would be the accounting treatment of property. So for those who don't know, like for example, every single company, they are required to prepare a balance sheet. So under your assets, you will typically have 2 main components, which are called the fixed assets as well as current assets. Fixed assets are commonly assets that you own, which you do not intend to sell within the short term. For example, your plant and machinery, cars, building, factories, all this, it will fall under the fixed asset. Whereas stock in trade are commonly items that you buy and sell quite frequently. For example, if you are engaged in selling toothbrushes, then your stock in trade would be materials required to make toothbrushes, whereas your fixed asset would be your factory, your machineries to produce those toothbrushes. Okay, so in the case of Para Construction, taxpayer was also a property development company. So they had they submitted plans to build a flat, but however, the plans did not go through and they did not proceed with the development. So the taxpayer actually converted these properties into their fixed asset account. What happened subsequently was that this was also a case of where the government compulsorily acquired the properties. And then so the court actually said that this was a capital transaction. So in finding that one of the considerations that the court actually took was that was accounting treatment of the property, because it held that there's evidence which is accepted by the court as establishing a sound commercial accounting practice conflicting with statute that normally is end of the matter. The court adopts the practice, applies it, and decides the case accordingly. So how the property is actually treated within the taxpayer's books is something that the court will actually consider in determining whether it is in the course of trade or a capital receipt. Okay, and in the case of ELF property, similarly, the taxpayer was also a property development, and they bought 7 lots of land. There were actually many plans going back and forth to build a 30-story office building. Note that the land was actually under the company's fixed asset. The question was whether the plans to build the office building go through. It didn't go through, and 10 years later, the taxpayers actually sold the land. So the court similarly decided that this was not a revenue ill receipt, but rather a capital. Just because the court actually took into account that the primary intention of the company to acquire the land was that they wanted to build an office building on top of it and receive rental income from it. So that they've been capitalizing the land under the fixed asset of the company, and therefore the court held that there was no intention to trade with the land, and so it was a capital and it was not taxable under the Income Tax Act. Okay, skills and specialty in the field. For example, if Brandon is a well-known stock trader, and then he has been trading stocks for like the past 10 years, and he has developed significantly knowledge about trading in stocks, although he is a practicing lawyer right now, the court may actually take that because of his knowledge in this field, Brandon is to be taken as trading in shares. So, next. So, but then, in the case of Lim Foo Yong, the Privy Council held that the disposal of the taxpayer's hotel was capital in nature, despite the fact that the taxpayer has been involved in property development. So, so whether or not you are you have special knowledge in this field, are an expert, or etc., if you can establish that whatever that you acquired or whatever was disposed of, the profit it made therefrom was a capital investment and not in the intention of trade, Brandon may have held a shares for 10 years, a Bitcoin shares for 10 years, and would be now a millionaire. He can actually take the position that the sale of the Bitcoin is actually capital in nature because he didn't dispose it. The intention was that he wanted to invest in the Bitcoin despite having engaged in trading of shares. Okay, method of acquisition and disposal. For acquisition, the question is whether how did the taxpayer come about to be able to acquire the finances required to, for example, purchase the asset. For example, in the case of a hypergrowth, the taxpayer, the IRB they did a tax audit, and the IRB found that the taxpayer didn't actually have the financial ability to acquire the shares. So in this case, the taxpayer actually took a loan to purchase the shares. However, the court was not favorable with the IRB, and they said that notwithstanding that the fact that the taxpayer took a loan to acquire the properties, it was nevertheless a capital receipt. If you remember, hypergrowth was the sale of shares. In the case, similarly, in the case of disposal, some of the questions that may arise is, for example, were there efforts made by the taxpayer to dispose of the asset? Like, for example, one of the case that I am currently assisting was that in this case, the taxpayer actually didn't do any efforts to sell the land. This was a building, and then they've acquired the building, but then they didn't do anything to shares to dispose of the property. Whereas the IRB took the position that it was taxable. But in this case, the taxpayer didn't do any efforts. They were like, they never got an agent to sell the land, but this case is ongoing. But in the case of YMF or KPHDN, the court held that the absence of any activity to render the land more saleable or special exertion, fine, or attract purchasers indicates that it's a capital transaction. Okay, recent developments. Okay, if you guys remember, like previously, in the previous slides, Brandon and I have spoken that, for example, for property developers, a property developer, they may treat the property as their stocks in trade. For example, because they're property developers, they build houses and then they sell them. But however, it is also similarly possible for a property developer to keep some of its assets as fixed asset, where in those previous cases, due to compulsory acquisition, the court actually found in favor of the taxpayer in finding that because of the compulsory forced sale, that these are not taxable. However, recently, a few years ago, there was the Parliament actually enacted something we call Section 4C. Just a reminder that Section 4C did not come into play in the previous cases, but it's a recent development, if I'm not mistaken, in 2016, 2017. What happened was that Section 4C actually says that if real property is your stock in trade and it is compulsorily acquired, those receipts are taxable under the Income Tax Act. Similarly, the corresponding section 24 sub 1 sub AA, it says that any stock in trade parted with by any element of compulsion, including on requisition or compulsory acquisition, or in a similar manner in or before the relevant period. So, a property developer who holds land, which is subsequently compulsory acquired, it is deemed to be taxable under the Income Tax Act and not under the RPGT or exempted from tax. Okay, so previously, what happened in the previous cases that Brandon and I have mentioned is that the property developers, they've been relying on paragraphs 3F, Schedule 2 of the Real Property Gains Tax, where it says that the disposal price is equals to the acquisition price, where the disposal is as a result of compulsory acquisition under any law. So for those cases, the taxpayers have been relying on this to say that because my land is compulsorily acquired, therefore it is exempted from tax. But the situation now would be slightly different due to the enactment of Section 4C. Okay, so moving on to Section 4F. Section 4F plays a rather peculiar role in the Income Tax Act, but nevertheless, it is basically the catch-all provision where it says that if your income does not fall into any of the previous subparagraphs, it would be deemed to be income for your, so it's be gains not falling in the previous subparagraph. But the question is whether Section 4F can be read to be wide enough to even capture capital transactions. So what happened in Leeming and Jones, this was also a UK case, where the taxpayer actually bought a piece of rubber estate and sold it for profit. the question was whether the sale of the rubber estate was a revenue receipt or a transaction capital in nature. In this case, it is notable to note that the revenue officers in the UK relied on the exact same aim provision, which is similar in reading to our section 4F. So this case actually went all the way to the House of Lords, and then they said no, that to rely on case VI, which is similar to our section 4F, it says that it must be something in nature of profits or gains in contradistinction to capital. So section 4F cannot be used to bring to tax anything which is capital in nature. Nevertheless, because as mentioned by my colleague Brandon, to be able to bring an income to tax under the Income Tax Act, it must be something in the nature of trade. And it says that the House of Law actually held that the limitations of the word profits and gains must mean profits and gains adjustum generis with the profits and gains specified in the preceding 5 cases. So regardless of whether it is section 4F or case VI of the UK income tax cannot be used to bring to tax capital transactions. And yes, in this case, the House of Law actually found that the transaction was capital in nature. Okay, so we do have a similar case in the Malaysian jurisdiction, which is in a case of K and RB because it's not reported. So what happened in this case was that this involves the sale of intellectual property rights. The taxpayer actually underwent a spin-off and then they sold their intellectual property where it developed by itself to a related party. IRB took the position that the sale of the intellectual property rights were revenue receipts. So this case went to the SCIT. In this case, the SCIT actually found in favor of the Inland Revenue Board officers in that they said that yes, the sale of the intellectual property, which was developed by the taxpayer itself, was actually a revenue receipt and therefore taxable under Income Tax Act. If they said that although the cases of NYF Realty and Alf Properties, these were cases where there were acquisition of properties and subsequently disposed of, whereas in this case, taxpayer actually developed the intellectual property rights by themselves and then they sold it. So the special commissioners distinguished it on these grounds. Other considerations taken was that there was no evidence of transfer of the ownership, as well as the amount received by the taxpayer actually represented a projection of future income of the taxpayer. So they said that because this was a loss, the compensation received by the taxpayer represented a loss of future income, therefore it was taxable under Section 4F. This case currently right now is under appeal to the Court of Appeal, as the High Court also filed in favor of the Inland Revenue Board officers. Okay, I'll pass it back to my colleague Brandon now.
Thank you, Sophia. Okay, this is a case which I've handled by me currently in RDS, and it involves an individual taxpayer who is actively involved in the trading and breeding of ornamental fishes such as koi fishes, and the taxpayer had disposed 10 plots of agricultural land, which are used to rear chicken and plant palm oil trees. And the 10 plots of land were disposed within a period of 2 years, 2011 to 2013. And upon the disposal of such lands, the state lands, the taxpayer had filed real property gains tax returns to the tax authorities However, upon an audit conducted by the revenue, they are of the position that the gains arising from the disposal of these 10 plots of land should be subjected to income tax due to the purported existence of badges of trade. So the main issue before the special commissioners are whether the said gains are taxable under the Real Property Gains Tax Act or the Income Tax Act. In reaching its decision, the special commissioners had found the following, whereby a short holding period of 1 to 4 years is actually not a factor to indicate that the taxpayer was indulging in the business of trading. This will be contrary to the general principle of a short holding period may indicate that there is actually a nature of trade. However, this will of course depend on the circumstances surrounding the transaction itself, and the short holding period should not be the sole factor to guide us on whether there exists any nature of trade. Secondly, the transaction was entered into by the taxpayer upon some pressure due to the restructuring exercise of the taxpayer's company. There was actually an issue whereby the company is in need of a parcel of a land, and that is why the taxpayer had voluntarily agreed to acquire a piece of land and therefore utilize the piece of land for the purposes for the company's operations. Therefore, subsequently, the sale of the plot of land was due to the unforeseen economic circumstances of the company, and therefore, such forced sale does not indicate any activity of trading, but instead it is deemed to be capital in nature. And thirdly, the fact that the sales were facilitated through the words of mouth amongst the acquaintances of the taxpayer does not indicate any form of special exertion in disposing the said lands. This will be related to the notion of the method of disposal, where in contrast, the taxpayer did not set up any sales gallery, hire any broker to facilitate the sales, or even putting up banners to promote the sale of the land. This will, of course, point to the direction that the sale is actually capital in nature and therefore should be subjected to real property gains tax instead of income tax. And moving on, the lands are actually agricultural land, and they are not industrial land. And therefore, such lands could only be used for agricultural purposes, such as the rearing of chickens, planting of trees, or any other activities related to the agricultural. So this will definitely point towards the direction that this transaction is actually capital in nature, and there is also no effort by the taxpayer to even make any alterations to the land, whereby the taxpayer had installed coops and coop fences, which are of course related to the rearing of chickens. However, such slight alteration does not in essence give rise to or indicate that the taxpayer had taken extra steps to increase the value of the plots of land. I mean, coop fences and the installation of coop fences does not require much capital, and these are just slight alterations for the taxpayer to rear his chickens. Based on the above findings, the special commissioners has found that the gains are actually capital and in nature and should be subjected to real property gains tax. So therefore, there is no basis for the revenue to say that the taxpayer had been indulging in the activity of trading in land. The case is currently still ongoing, whereby the revenue has pursued a further appeal to the High Court, and the outcome is still uncertain yet, as the hearing will take place in the near future. So, how do we, in effect, prove intention on the part of taxpayers to undertake an adventure in the concern of a trade? Therefore, few factors are actually indicative on whether there is actually an intention of the taxpayer to undertake trading. Firstly, being documentation evidence, documentary evidence that shows the purpose of the acquisition, whether it is actually for investment or business. Secondly, the board resolutions will of course indicate that whether a company intends to acquire a particular property solely for investment or to facilitate their business, their day-to-day operations, or to be used as their stock in trade. Thirdly, there is also whether a formal valuation exercise was undertaken. Fourthly, minutes of meetings, which of course shows that the intention of the board of directors on their intention of acquiring or disposing a particular property, the expertise of the taxpayer in that area, as explained by Sophia earlier, the accounting records, also whether the particular property is recorded as a fixed asset or stock in trade in the financial statements will be, of course, conclusive evidence to indicate that whether a particular property is kept for investment or for trade. And of course, in the cases of Clearwater Sanctuary and Perak Construction, it is established that due regard must be given to such accounting records, and also the subsequent conducts of the taxpayer in handling its affairs pertaining to the properties in question. And that is the end of our presentation. And now we shall move on to the Q&A session.
Okay, so one of the questions is, what is the difference between revenue and profit? Profit is revenue minus cost. Yeah. So that's that. Brandon, do you want to answer the next one?
Stay for a moment.
Okay, well, Brandon.
Okay.
Okay,
the second question is by this anonymous attendee. Is it not income earned abroad exempted from income tax? Generally, income earned abroad will be exempted from income tax in Malaysia, but however, it will be taxable in the country of origin. And this was actually, yeah.
So the next question is cryptocurrency gains taxable? As mentioned, so it depends on how long you've been holding your crypto coin. So for example, if you were one of the early birds and then you bought it like 5 years ago and then you only sold it like now, chances is the sale of the crypto coin is actually a capital transaction and not taxable because Malaysia does not have a capital gains tax regime. But say if you trade crypto coins quite frequently, it can be a revenue receipt. Brendan? Okay, I think his computer is lagging a bit. I'll just take the next question in the meantime. Why is real property taxed as capital gains but not disposal of other types of capital items? That's because Malaysia, we only have a real property gains tax, and we do not have a capital tax regime. So for example, if you were to purchase shares and sold it and it's a capital transaction, that is actually not taxable at all. Okay.
Maybe I could take the next one. It's just fulfilling one batch of trade makes it automatically revenue in nature. Actually, the answer to that would be no. By just establishing the existence of one batch of trade is not sufficient to actually show that the taxpayer is actually involving in the trade, an adventure in the concern of trade. However, it will of course be best if one could establish the existence of a number of badges of trade to of course indicate that, and also the surrounding circumstances of a transaction, which will of course holistically point towards whether a particular transaction is actually capital or revenue in nature.
Okay. Is ang pao taxable? No. Brendan?
I mean, 1 million toilet rolls, I think we could skip on that. Isn't it common to take a loan to buy a house? If taking a loan is indication of trade, where's the line drawn? Okay, the mere conduct of taking a loan, of course, may indicate that there is a conduct on the part of the taxpayer whereby the taxpayer has insufficient resources to acquire a particular property, and that is why they are taking a loan. However, it does not per se indicate that it is actually trading in nature, whereby taxpayers, let's say individuals like Sophia and I, whereby we are purchasing our first residential property, and of course, there are circumstances whereby we will need to take up a loan for this to finance the purchase of this residential property. And this will not definitely indicate any nature of trade whereby we are solely buying our residential property as also as an investment and also as our home.
Okay, next one. Dividends and fixed deposits interest chargeable by anonymous attendee? No. Ever since the single tier dividends in 2009, dividends are no longer taxable under Malaysia, as well as fixed deposit interest. If it's received by an individual, it is not taxable, but however, fixed deposits on interest received by companies are actually taxable.
What is the difference between trading, commerce, and business? In essence, they actually mean the same thing, which is actually buying and selling. But of course, business in itself has a wider definition, whereby it involves what is that? A business organization. It could be a business organization in itself. But in essence, yes, they are actually the same thing, of the conduct, the activity of buying and selling, or the provision of goods or services. Can an avid collector of luxury properties, watches or cars, be required to declare income tax upon the disposal of such properties? Okay, let's say Sophia is an avid collector of Chanel bags. She has maybe around 50 Chanel bags in her wardrobe. As long as Sophia is not engaged in the actively engaged in the activity of buying and selling bags at a short span of time. So let's say one day Sophia goes to Pavilion and sees a bag that she likes, and she has collected such bags, but the disposal will of course be capital in nature, whereby it is the subject matter at hand is, of course, it is solely for Sophia's personal enjoyment, and there is no reason for Sophia to let go her prized possession, or maybe sometimes whereby maybe she gets bored of it, that will be capital in nature.
Or if Sophia suddenly needs cash and due to the financial compulsion she
Yes,
needs money, yes,
that will of course give rise to circumstances responsible leading to the transaction.
I wish I also have 50 Chanel bags, Brandon. Okay, next. Okay, from Melissa. Chong aspires to be a hype beast by forcing his mom to purchase ultra expensive clothing. However, Chong gets bored easily and sold his LV X Supreme hoodie for
I think this question is actually the same as the previous question, so it will be capital in nature.
Yeah, agreed, Brandon. Next question. My main occupation is an accountant, but I sell egg tarts on weekend to earn extra income. Is it taxable? This would be a prime example of income taxable under Section 4F, where it is considered as a casual income, although it is not in the course of your employment. Brandon, do you want to take the next one?
Is it possible for an individual who owns a significant number of residential properties through inheritance and investment be subjected to income tax by disposing? Okay, let's say such properties are the sole intention. Therefore, we have to go back to the intention of acquiring these properties. If the sole intention of acquiring such properties are solely for investment purposes, then of course it will be capital in nature, whereby the taxpayer disposes his properties, let's say, over a period of time, instead of disposing 50 properties in one transaction. However, if the taxpayer or individual is also actively engaging himself as a property agent, whereby he buys and sells a number of houses, then of course this will of course indicate that there is a nature of trade, and it may attract the imposition of income tax.
Okay, next question. My parents.
I think we have answered that. That is not taxable under income tax.
What is most susceptible to the determination of whether a person is considered to be trading? This is quite a subjective question, and it depends on the facts of each case. Like, for example, what is the nature of your job? If you are engaged in, for example, like Brandon just now mentioned, like you buy and sell Chanel bags for the to make a quick turnaround profit, then in those cases, you might the sale of the Chanel bags and the profit made from there on, it can be taxable under income tax. But for example, if you were to just hold it, you are not engaged in trading in Chanel bags and you just hold it for a period of time and subsequently sell it, then it's actually a capital receipt. So it would depend on the facts of each case.
Okay, moving on. Can selling RPT, I believe it's RPC shares real property company, to be considered to be RPGT instead of income tax? Of course, the disposal of RPC real property company shares will be subject to RPGT instead of income tax.
What if I stay in the house and renting one room to one tenant? Is that taxable? It will be taxable under Section 4C as a rental income. Okay. Brendan? Okay, next question is how to define asset when we still have a mortgage loan with the bank? Bank still owns the property, right? If I rent it out, then so if you were to take a loan, it depends if you. I take it that you're not a company, but even if you were to take a loan to purchase an asset, the asset will be the house can be considered as like your long-term asset, and then because the house is still it will be registered under your name, so it can be your asset. It's just that you have a liability in that if in the event that you were to default on your mortgage, then the bank would have ownership of the asset. So in a sense that even though you were to buy a house under a loan, it would still be considered as your asset. If you rent it out, then you would essentially be receiving rental income.
Moving on is home-based tuition. Do we have to pay taxes on gains derived from home-based tuition? Such income will of course fall under the heading of Section 4F, and that we have to declare such gains to income tax.
If I inherit a diamond ring from my mother and I sell it, is it taxable? No. Most likely it will be a capital receipt because you are not engaged in buying and selling of diamond rings.
There's a question from Vanessa saying, can one be taxed under Income Tax Act as well as the real property gains tax for the same thing? Actually, no. That will be actually unconstitutional, and it could be subjected to challenge in our courts, as this will arise as the issue of double taxation will arise.
A question that I also see is that if I am in the business of selling properties as a property agent, but I sell my personal property, would this be considered revenue or capital in nature? It depends on how long you actually hold the property. Like for example, if in the course of your knowledge, you actually were able to obtain information on a certain property and you make a quick gain out of it, it might be taxable under income tax. But for example, if you actually held the property for a very long time, like 10 years, arguably it's actually a capital receipt. What is the meaning of unreported in case law? Unreported, that means it has not been reported in any of the law journals. For example, we have CLJ, LMJ, CCH, all this. So basically, it's not been reported. Yeah, as in, like for example, the grounds of judgment is not out yet.
There's a question by Kuo Shen Yao. Is there inheritance tax in Malaysia? If no, is it coming anytime soon? At the moment, there is no inheritance tax in Malaysia, but on several articles, the government has indicated of implementing an inheritance tax, but we are uncertain of when that will be imposed. And maybe we could speculate in the near future, I suppose.
Okay. Next question. If I have stocks as my side income but rarely buy and sell it, i.e. at most 10 at a time, is it taxable? Arguably, it is not taxable. It's a capital receipt, but then again, it depends also because the repetition of the transactions, the IRB can take the position that it is revenue in nature.
Can the practice of buying and selling quoted shares through Bursa Malaysia be subjected to income tax? Of course, the buying and selling of quoted shares through Bursa will be considered a capital gain, and there is actually no capital gain capital tax regime in Malaysia. So this will fall squarely within the effects of the case of hypergrowth, as previously explained by Sophia, and it should be capital in nature.
If a YouTuber is trading and also make income from promoting it on YouTube, is it taxable? also makes money from promoting it into you. If you're a YouTuber, then yes, it would be taxable.
I think what the
Or also,
question
yeah. Or also if you receive sponsorship items and then you promote the items on YouTube and you receive a remuneration from it, then yes, it's also taxable. Or any other brand? Okay, next question. Can tax matters be solved via mediation or arbitration? Unfortunately, Malaysia, we do not have a mediation arbitration system for tax, but income tax cases normally are referred to the DRP before the matter gets referred to the SCIT.
trading in shares, is that the gain or trading in shares taxable for an individual? Okay, I believe we have answered this. But if he acts as a stockbroker, whereby he actively day trades and or in other words, buy and sell shares on a daily basis, then it may fall under the category of trading instead of buying a bulk of shares and for the sole to hold it for a period of time for the sole intention that the price of the stock will increase.
Can renovation cost of office be deducted from taxable sum? Renovation cost of office is typically capital it are capital expenses. You cannot deduct them straight outright from your revenue, but you can claim something we call a capital allowance under Schedule 3 of the Income Tax Act for the renovation cost. I think this is already.
Would you say that Section 4C is unconstitutional? Maybe Sophia, you could answer that.
We do have, without speculating, it depends on the interpretation of Section 4C in line with the rights of taxpayer under the federal constitution, which is the right to adequate compensation. So because this is still an ongoing matter, I'll reserve my comments.
Yes. Maybe we could take a few more questions.
Yeah, I think it's just a few more.
Is allowance from my parents taxable? No. With businesses for small business earning less than 30,000 per year. Yes, actually we do for small businesses as well. Let's say one day I decide to open a chicken rice stall and quit law. And of course, I will have to pay taxes on the gains, on profits that I make from selling chicken rice.
Okay, next question. Thanks, but however, if you are exempted from RPGT, could IRB still raise an assessment under ITA? Yes, they can. There's actually one of the cases where I can't remember the case name, but the IRB actually issued a tax clearance letter to the taxpayer in respect of RPGT, and then subsequently the IRB actually revoked the clearance and then issued an assessment under ITA. So yes, as long as they bring it to tax under one of the acts, but not both, it is taxable.
A question from Question Yao, is pupillage allowance taxable? Generally, no. Pupillage allowance is not taxable. Basically, it is an allowance and it is not an income derived from an employment because a pupillage is actually not an employment whereby there is no contract and the pupil is actually not bound to the firm.
What is the difference between MLJ and MLJU? MLJU has less and low authority and cannot be used to support legal suit. There is no difference. It's just different publishing companies, different publishing journals. So no, there's no difference. It's just different books. What do you mean by no cases to refer to mediation arbitration? Basically, because Malaysia, we do not have a mediation arbitration scheme for tax cases. Tax cases are referred to either the Special Commissioners of Income Tax, Customs Appeal Tribunal, or they get referred to the High Court. So there is no arbitration process. So sometimes it depends whether the judge, they releases the grounds of judgment. If they do, then we would know the reasons, but if they don't, then we will not, then the matter will not be published.
Okay. What the most the government can do on us if we don't pay taxes and really has no money in jail? Actually, yes, the government will initiate civil recovery proceedings against taxpayers, subsequently obtain a judgment, and further down the road, they may even take execution proceedings such as bankruptcy or winding up. But however, jail
possible, yeah,
possible
prosecution action.
Persecution, yes.
Okay, there's a question on Facebook by Guan Leong. For holding of shares, in what circumstances IRB will view it as part of business instead of investment, especially in terms of shares holding period? So I think in one of the previous cases where I mentioned, where it says that one of the objects of the company was actually to trade in shares, that is actually an indication that the company is trading in shares and therefore it will be subjected under the ITA. So for example, whether there's clear documentation for the company to with regards to the intention to acquire the shares, those are important to prove if the position of the company is that these shares were held as investment asset.
Any more questions you would like to answer, Sophia? Maybe this last one by Portion Yao. In practicing tax law, how often you have to speak in Bahasa Malaysia? Actually, quite often, whereby we are required to attend court very frequently. So we have to be fluent in BM as well.
Yeah, note that your course papers are actually in BM for the High Court matters and above. So yeah, I think that concludes our talk today. Before you leave, for members of the bar, please do send your please refer to the chat box where we say that please email your name, law firm, as well as bar council number to bd@RDS Law Partners to be able to obtain the CBD points. Thank you very much for joining us today, and we hope to see you in the next CLE session. As always, stay safe, take care, and we'll see you soon.
Thank you very much, everyone.
Thank you.